Okay, let's talk about one of the biggest money decisions you're ever going to make: hiring a financial advisor. I mean, it's a huge deal. But what if the very person you're paying to grow your wealth is actually making you poorer? It's a scary thought. So today, we're going to break it all down. We're going to give you a simple, data-driven framework to figure out for you if an advisor is a smart investment or just a really costly mistake. All right, let's dive in. It really all boils down to this one question, doesn't it? We all want that professional guidance, that peace of mind. But at what cost? This is the fundamental tension every single one of us investors has to face, trying to balance the potential value an advisor might add against the fees you are absolutely guaranteed to pay. And here it is, the core conflict. On one side, you've got advisor alpha. That's the potential extra value, the boost a great advisor can bring to the table. And on the other side, fee drag, that guaranteed cost that just slowly, quietly erodes your wealth over time. It is a battle for your returns, and we are about to see who usually comes out on top. So, first things first, let's tackle the positive side of this equation. What exactly is this advisor alpha we're talking about? Where does the real value of an advisor actually come from? Let's unpack it. Well, you'll be happy to know it's a real thing. Research from big firms like Morningstar shows that advisor alpha can be a measurable boost to your returns. We're talking anywhere from 1.5% to almost 5% extra per year. But the million-dollar question is, where does that value actually come from? And the answer, well, it's probably not what you think. Just look at this breakdown. The single biggest piece of the pie, it isn't some brilliant stock picking or market timing. Nope. It's behavioral coaching, making up a massive 37% of an advisor's measurable value. Their most important job is to be that calm, rational voice that stops you from making emotional and really costly mistakes. And why is that coaching so important? Well, it all comes down to this one number: negative 2.84%. That's how much the average investor underperforms the market every single year because of emotionally driven decisions. It's called the investor behavior gap, and a good advisor's main job is to close it by keeping you disciplined. They're literally paid to protect you from yourself. Okay, so we've seen the potential upside. Pretty compelling, right? But now let's flip the coin and look at the other side of the ledger, the guaranteed cost. This is the villain of our story, the slow, compounding drain of advisory fees. On average, a traditional financial advisor is going to charge you just over 1% a year on the assets they manage for you. So, to put that in perspective, for every $100,000 you have invested, you're paying them about $1,000 a year. 1%. I mean, that sounds almost trivial, right? Kind of like a tiny price to pay for all that professional guidance and peace of mind. But the true cost, the real cost, isn't what you pay in 1 year. It's what that 1% costs you over an entire lifetime of investing. And this is where that tiny little fee becomes an absolute monster. Over 25 years, that small 1% fee on a $500,000 portfolio can cost you over $560,000 in lost growth. I mean, that's a house. That's retirement. That is the brutal power of fee drag. It's this massive, massive hurdle your advisor has to clear just for you to break even with what you could have done on your own. So if you're gonna pay that fee, you need to be absolutely 100% certain that your advisor is working for you and not just for their own commission. And that brings us to the most critical, non-negotiable part of this whole decision: their ethical code. Okay, this is so important to understand. An advisor held to a fiduciary standard is legally required, to act in your best interest, always. It's the highest ethical standard there is. But many others operate under what's called a suitability standard. This just means their recommendation has to be good enough for you, not necessarily the absolute best or the most cost-effective option. The difference is truly night and day. And you know what? How they get paid tells you everything you need to know. A fee-only advisor is paid only by you. That means their interests are aligned with yours. They're fiduciaries. But commission-based and fee-based advisors, well, they can also earn money by selling you specific products, and that creates a huge conflict of interest. They might be recommending a fund because it's good for you, or because it pays them a higher commission, and you can never be totally sure which it is. So for decades, those were really your only options. But a new contender has come along and completely changed the game, offering a really powerful, low-cost alternative that challenges that entire traditional model. let's talk about the rise of the robo-advisor. I mean, just look at this. The cost difference is staggering. While that traditional advisor is charging you over 1% a year, the average robo-advisor charges just 0.25%. By using technology, they've basically made professional money management accessible to everyone, and for a fraction of the cost. And how do they do it? Well, they automate some of the key parts of that advisor alpha we talked about earlier. They handle all the complex stuff, like portfolio rebalancing, tax loss harvesting, and goal-based investing. All of it, automatically. So you're getting some serious value for way, way less money. And the market today is just full of amazing options. You've got platforms like Betterment, Wealthfront, Fidelity Go. They all offer incredibly sophisticated tools. But what's really exciting now is the rise of the hybrid model. For just a slightly higher fee, maybe 0.35 to 0.65%, you get the automated platform plus access to a real human financial planner. So you get that all-important behavioral coaching we talked about. It's kind of the best of both worlds. Okay. Wow, we've covered a lot of ground. We've looked at the value, the cost, the ethics, the alternatives. So now, let's pull it all together into a simple, strategic framework you can actually use to make your decision. All right, if you're thinking about going with a human advisor, you have to do your homework. Your due diligence here is absolutely critical. First, ask them how they're registered. Second, use FINRA's free broker check tool online to look into their background. And finally, you have to read their Form ADV. That's the official disclosure document where they have to list all their fees and any potential conflicts of interest. It's all public information. You just have to look. But look, if you forget everything else, please just remember this. This is the single most important question you can ask any potential advisor. And the answer has to be an immediate, no hesitation, yes. If they start talking around it, if they hesitate, if they say, well, it's complicated, you get up and you walk out. Seriously. End of story. So here's the final takeaway, a really clear strategic path forward. If your financial life is super complex, you're dealing with things like executive compensation, complex taxes, or estate planning, then paying the premium for a dedicated fee-only fiduciary is absolutely worth it. The cost of a mistake there is just way too high. But for most of us who are focused on building wealth and planning for retirement, that low-cost digital hybrid model is the sweet spot. You get the automated management and that critical human coaching, all for a fraction of the traditional cost. At the end of the day, the choice is yours. But now, you have the data and the framework to move forward with real confidence, knowing exactly what you're paying for and the value you should expect in return. So the real question is, how will you make sure your money is working for your best interest and not for someone else's?